I'm a self-made millionaire with over $10 million invested in real estate. And if I could go back and do it all over again, here's exactly what I would do differently. Most people think finding a good real estate deal is about luck or timing or knowing the right people. It's not. I've wasted years making mistakes that cost me hundreds of thousands of dollars because I didn't have a system. But once I figured out the 7-step framework, everything changed. I went from struggling to find one decent property to building a $10 million portfolio that generates over $10,000 in passive income every single month. In the next few minutes, I'm going to walk you through the exact system I wish I had when I started, the one that would have made me a millionaire twice as fast. So let's dive in. Here's your step-by-step guide to finding good real estate deals. And look, this isn't theory. This is the exact process I used to build my portfolio from zero to over $10 million in real estate. And if I was starting all over today with absolutely nothing, this is exactly what I would do. Step number 1, you need to know what kind of real estate investor you're going to be. And here's why this matters. When I first started, I was all over the place. I looked at flips. I looked at wholesaling. I looked at commercial properties. I was chasing every shiny object instead of focusing in on one strategy. And that lack of focus cost me time and money. So what are your options? There are long-term rental investors, short-term rental investors, flippers who buy distressed properties and sell them at profit, wholesalers who secure properties under contract and flip those contracts within 30 days, commercial investors who focus on office buildings and retail spaces, and then honestly, so many others. There are a ton of ways that you can invest in real estate: storage, mobile homes, all kinds of things. Now, if you're someone who wants quick cash and doesn't want to hold property long-term, flipping or wholesaling might be your path to get started. Many people start this way to learn the game without risking lots of capital. But if you're looking to build sustainable, long-term wealth with consistent cash flow and massive tax advantages, which is what I did, then you're going to want to focus on long-term rentals or short-term rentals. These are the strategies that built my $10 million portfolio. So for the rest of this video, I'm going to focus on long-term and short-term rental investors because that's where the real wealth building happens. And that's what I know works because that's what I've done myself. Okay, step 2, look for markets with rising or at least stable demand. This is critical and it's one of the things that we've done really, really well. I've chosen to only invest in our local market because I know it really well and because we have a rising demand for rental property due to our strong job market, presence of several Fortune 100 and 500 companies, and an emerging health and tech job market. Early on, my husband and I bought a lot of rental property in a part of Richmond that a lot of people wouldn't consider a good investment, but we saw the potential for rental demand rising because of the proximity to the city center and other large-scale developments happening nearby. And those properties today worth hundreds of thousands of dollars more than what we paid. You need to look at the data: population growth, job growth, infrastructure development. These are all indicators that tell you whether a rental demand is going to increase or whether it's going to decrease in the coming years. At minimum, you want a market where the population is stable. Ideally, you want steady population growth because that's what drives up rent prices and property values over time. Once you've identified strong markets, then you can start looking at properties on Zillow, Redfin, Realtor.com, and Trulia. But notice the order here: market research first, property shopping second. If you do it backwards, you're just gambling. And this isn't about gambling, it's about investing strategically. All right, step number 3, look for cash flow positive properties, not cash flow neutral. A cash flow positive property generates more rental income than the total expenses every single month. And those expenses need to include what we call reserves. These are expenses that might not happen this month, but eventually will happen. $800 for a new hot water heater, $12,000 for a new roof, $1,200 for a new refrigerator. I like to set aside $150 to $200 per unit for a rainy day. So if you had a triplex, that would be $450 to $600 total. But back to my point, if your expenses are $2,500 a month, you need to bring in more than $2,500 in rent. It is simple math. And yet I see so many new investors skip this calculation entirely. They buy a property hoping that it'll work out, and then they're shocked when they're losing money every month. We've avoided this mistake by taking the time to run the numbers, and here is how you calculate it. First, you're going to estimate your rental income by using sites like Zillow or Rentometer. We pay for Rentometer to get more accurate rents in the area, and I would recommend that you do this as well. Then you're going to subtract all of your expenses: mortgage, taxes, insurance, maintenance, property management, everything. If the number is positive, you have a cash flow positive property. If it's negative or neutral, keep looking. Now, cash flow is going to depend on how much you're putting down. To learn how to run the numbers on a deeper level, I'd recommend using Rehab Valuator. This is an online platform, and there's tons of videos in there to teach you how to understand if a deal works on a deeper level. Now, step number 4 is something I didn't learn until I was 5 properties deep, but it's something absolutely critical. Look for properties with a good building to land ratio. This is an expert level factor that can dramatically impact your tax strategy and your wealth building speed. What I mean is that at least 80% of the property's value should come from the building structure and 20% or less from the land. Why does that matter? Because you can't depreciate land. The IRS doesn't let you write off land because land doesn't break down over time. But the building, that depreciates. And that depreciation is one of your biggest tax advantages as a real estate investor. So if you buy a property with a high building to land ratio, you get a much larger depreciation deduction, which means you save substantially on taxes. And saving on taxes means more cash in your pocket to reinvest. Okay, step number 5, look for properties in states that allow accelerated depreciation. Now, what is accelerated depreciation? First, you need to understand depreciation. The IRS spreads the cost of a residential rental property over 27 and a half years. For commercial properties, it's 39 years. But with a cost segregation study, you can accelerate that timeline by separating structural components from non-structural components like light fixtures, flooring, and appliances. Those non-structural items can be depreciated much faster, giving you a massive deduction in the first few years. But, and this is important, some states like California, New York, and Connecticut restrict accelerated depreciation on a state level. So you can still do it federally, but you lose the state benefit. So if you're serious about maximizing tax savings like I am, definitely consider investing in a state with friendly depreciation rules. It makes a huge difference in how fast you can scale. Step number 6, network with local real estate professionals to find off-market deals. This is where you separate yourself from the average investor, and it's how I found some of my best properties. Most people think that the best deals are on the MLS, but they are absolutely not. The best deals never hit the public market. Off-market deals come with less competition and better pricing, which means better cash flow and higher profitability. But you can't find them by scrolling online. You have to build relationships with real estate agents, wholesalers, property managers, and contractors in your target market. Attend local real estate meetups, join investing clubs, participate in online forums, and reach out directly to professionals. Let them know that you're a serious investor looking for cash flow positive properties and ask them if they'll send some deals your way. Now, it's going to take time. Wholesalers and real estate agents are going to have other investors that they're sending properties to, but over time, you'll build a network that gives you access to opportunities that other investors will never see. I cannot tell you how many of our properties came from a phone call or a text from someone in my network saying, "Hey, I've got a deal you might be interested in." These relationships are worth their weight in gold. Build them early, nurture them consistently, and they will pay dividends for decades. Step number 7, take the property inspection seriously to avoid properties needing major repairs. The condition of your property directly impacts your cash flow, not just today, but 5 years from now and 10 years from now. And trust me, I've learned this multiple times. We've done several historic tax credit renovations. We've kept the property as a rental. And sometimes the issues those homes have just turned into cash flow killers. There are certainly conditions that I've learned to stay away from, namely wood siding. Focus on properties in solid condition. Steer clear of anything requiring major repairs like foundation issues, extensive roof damage, or outdated electrical and plumbing. Major cosmetic fixes are fine. Outdated paint, worn carpet, but major structural problems will eat into your budget and delay your ability to generate income. I'm not saying never, but you have to walk before you run. It takes a little while to get comfortable with estimating costs and doing it accurately. And the last thing that you want is to jump on something that looks like a deal only to uncover it is a money pit because you didn't accurately assume the cost of all new electrical. Hire a reputable inspector and review the report carefully. If they find significant problems, be prepared to walk away, no matter how attractive the price seems. You can also negotiate with the seller to cover repair costs or lower the price, but always prioritize properties that are move-in ready or require minimal work. That's how you eliminate unforeseen expenses and scale faster. I built a $10 million real estate portfolio using this exact 7-step system. And if I had to start all over from scratch today, this is exactly what I would do. If you're serious about building wealth through real estate and you want to learn more about my strategies, make sure you subscribe to this channel. I share everything I've learned, the wins, the losses, the tax strategies, the deal analysis, all of it. Because I genuinely believe that real estate is the fastest path to financial freedom. And I want to help as many people as I can achieve what I've achieved. Also, if you found this valuable, do me a favor and hit that like button. It helps the algorithm show this video to more people who need to see it as well. And drop a comment below telling me which step is the most valuable to you. I read every single comment. If you want to go deeper, I've got another video right here about the tax strategies that I use to keep more of my rental income. That's the secret sauce that most investors miss. So make sure you check it out. As always, guys, thanks for watching, and I'll see you on the next one.